person was. I think he sounded something along the lines of, all right, listen up, ladies and gentlemen, our fugitive has been on the run for 90 minutes. Average foot speed over uneven ground, barring injuries, is 4 miles per hour. That means that gives us a radius of 6 miles. And what I want from each and every one of you is a hard target search of every gas station, residence, warehouse, farmhouse, hen house, outhouse, doghouse in that area. Checkpoints go up 15 miles. Your fugitive's name is Dr. Richard Kimball. Go get him. All right, December 5th. Little love today for some good films. A little Fugitive, and I watched Bull Durham last night. We're going to talk about momentum. We're going to talk about the runner. And we're going to talk about volume-weighted average price. Everything is in play on a Friday morning, Friday afternoon. Why are you getting crushed big time on XLU? I don't know. XLU? That's a very random question. I'll tell you in a second because we actually do know the answer to that. You shouldn't be getting crushed. We just bounced off the 100 minute or 100 day EMA. I'm actually looking to go long on this, but we'll talk about this momentarily and what happened with momentum. All right. Start with the doghouse. I have a big empty space in my backyard that I'm actually very worried about because there's nothing inside of it. It's where a tractor should go, and I would not be shocked to find the one-armed man in there later today at 11 o'clock. You're joining us today because, well, look, we have come right out of a huge V-shaped recovery. Have you seen what the IWM has done? Have you seen what momentum has done? We've talked about this time and time again. Back on November 21st, Japan drops $117 billion from the sky. Insiders load up for the highest amount of insider buying to selling since April 28th. We saw an uptick in buying. We saw zero buying pressure around the 20th. We saw an increase in leverage, and we saw momentum return to the market last Wednesday, and we continue to move higher toward all-time highs. But is this a trap day? We have the Fed coming up next week. Very critical meeting with an 87 to 88% probability of a rate cut. If things change, and we know they can change pretty quickly, especially with a round of inflation data coming out and consumer sentiment coming out as well. Oh, here's a fun headline. $208 million wiped out. Yield Street investors rack up more losses as the firm rebrands to Willow Wealth. Yeah, this is exactly the point. The stuff in all of that private credit, not looking good. All right, but all of those things continue to simmer. All of those questions remain. Looking at futures right now, we're within an earshot of all-time highs. S&P 500 pushing futures to 68.65. Russell flat, everything flat, everybody waiting for data. Huge move on natural gas, huge move on silver, and copper blowing through all-time highs at the LME, which we will talk about today as well. Great day for commodities, bad day for orange juice, and Bitcoin still under some stress, 91,000. Keeping a close eye on that. We're going to talk about volume-weighted average price and how to prepare accordingly for trades like that. XLE, XLK, XHB, we'll mention that as well as we will go through momentum in a little bit. But we start with momentum on the broader scale. And this is the metric, this is the rule, this is the stuff that people think that it is, I don't know, something that a coven would come up with. Is that it? What's a group of witches called? A coven? Who cares? It's not alchemy, everybody. It's literally just math, and all you're doing is taking the number of stocks on the outside of a bell curve, number of stocks breaking out versus breaking down, X minus Y equals color, green, red, yellow. We've been green since last Wednesday morning on the S&P 500, and that is, again, just a reminder, it takes a couple of days for things to recover, but as we've talked about and as we've discussed, it is a measure of a one-week momentum metric. Very important to keep this in mind, but as we noted back here on the 20th and the 21st, massive insider buying took place around the 19th, 20th, 21st aggregate. We saw a policy change with the Bank of Japan on its stimulus, even in the face of higher interest rates. We saw a 0 on the number of stocks that were breaking out on the 19th and the 20th. It all set up for a squeeze, and the squeeze turned into a rally, and now here we are, back kind of where we were projecting. I was expecting only around a move to 680. The natural inclination is, hey, well, this is going to roll over, especially heading into the Fed. I don't know. But I will say right now, it is pretty fascinating to see that yesterday we were basically down in an environment where we had no stocks breaking down. And we're kind of flat on the S&P 500 on intraday numbers as we look at it pre-market. These numbers will change when the market opens, obviously, but everything across the board positive. And then looking at all sectors, what is positive, what is negative? Well, 10 sectors are positive at the moment. The only sector that is not seeing the flows, oh, forgive me, there are two. Consumer defensive, which is not shocking because, as we note, when we get stimulus, money does not flow typically into this sector. Now, we saw a little bit of a pop and a little bit of a run, all boats rising, but money moving out of defensives and shifting toward the tech side, TECL, showing strength. And on the other side of this, wow, I didn't even see that move. PLBY, is that Playboy? Playboy up 18% yesterday. Yippee. On top of that, it's the XLU. And the XLU has been breaking down since mid-October. Not a lot of momentum in the utility space, but I do like it coming off of that 100-day moving average. It tapped it on the 4th. It's yesterday. And I can get on board for a little bit of a recovery. I'm actually looking to sell spreads on the XLU to the downside. We'll talk about that later today when I am trading live with people in the NVIDIA 4D group. Real quick, Bank of Japan, rate shock. All right, so Bloomberg reporting that the BOJ is likely going to raise rates this month. The U.S. dollar, again, we've fallen to 154 on the headline, and verbal intervention from Japanese officials followed the spike. Verbal intervention has been the story of the Bank of Japan over the last year since that Nikkei crash happened in August of 2024 that nobody wants to talk about. But that said, we just saw Japan step in, even in the face of rate hikes of injecting stimulus into their financial system. Again, a clear sign of stress somewhere in the plumbing of the financial world. Been worried about Japan for the better part of a year. And of course, we're keeping an eye on what's going on with the repo markets. This would be the first real tightening in Japan, well, really 15 years of global easy liquidity. This has been the money printer for the whole financial markets. That is the carry trade. That is where you borrow Japanese currency, very cheap. You take that money and you invest it elsewhere in the world. And what happens is you pay 1% in interest costs and you invest it in U.S. equities where you can make 15 to 20% a year. Keep the spread. Keep the 1,900 basis points and pay back the 100 basis points and do it over and over and over again. Well, the problem is that that trade is facing stress, and that puts stress on all of the things that have been levered up here in the United States for a long period of time. And if money flows out of Japan, it can fall, or out of the United States back to Japan. The same thing can follow all across the world. That's why there are concerns around cross-border flows and questions about whether or not money is just going to leave the U.S., that 19% of the S&P 500, or forgive me, the U.S. equity markets, that is owned by foreign investors. We'll see. We'll follow momentum. Watch the 20-day, watch the 50-day moving averages of the S&P 500 and the Russell, and we'll go from there. Key tickers to watch, the EWJ, which is the ETF around Japan, the DXJ, the FXY, and, of course, global banks and high valuation tech. On top of this, copper moving through an all-time high on the LME. 3-month copper hit U.S. dollar $11,700. I can't read. You know that. Driven by supply tightness, refinery strains, questions about Japan, and strong industrial orders. The AUD rallied alongside metals complex. That is the Aussie dollar. Why it matters, it confirms the ongoing argument that people have around the early stage commodity supercycle behavior. Rotation into miners and global basic resources underway. Real assets, real things, getting your fingers in the dirt. The very story that we have been telling since March 2024 in this construct of what we called the hedge of tomorrow. Repricing inflation expectations across the world, and it's not just about supply and demand. This is also a story about the ongoing issue around the Bank of Japan and what's happening with China. Remember, when China engages in easing and keeps loose monetary policy, that is bullish for commodities, particularly manufacturing commodities. The issue, unfortunately, is that this will have an inflationary impact on virtually everything. So FCX, SCCO, BHP, Rio, Vale Valley, I can't pronounce anything. VALE, let's just do that. COPX, who cares? Key thing. If you are focusing on this and you're asking questions, do we buy copper here? How about selling spreads? How about selling to the downside? And if you get assigned, you get assigned. And if it rallies, you still make money. And if it pulls back, you're still in a prime position for the next leg up. Now, if we look at the futures and we look at what's going on with copper right now, obviously you see this figure right here and what transpired back in June and July. But I'm talking about the LME futures, which is already a problem, given the fact what's going on with silver at the moment. You can sell spreads down at the key moving averages and look for the retest and look for the next move up. This is not going to be a massive sustainable thing. But once again, you got people running around saying copper's going to $8. I've heard this story for years and years and years and years. It's when you get up to $6, that's where you start to see demand destruction. And again, you start pulling stuff out of the ground when prices start to move higher. The old adage going that the cure for higher prices is higher prices. Baidu is spinning off its AI chip unit. Hey, this should be on people's radar. The fact that a company like Baidu, which is a very large, sizable tech company in China, may be the first to see the writing on the wall and simply stating, hey, what if we just rolled this out of our business and we just let everybody bid it up? They're exploring an IPO for Conluxin chip division, positioned as a direct challenger to NVIDIA's AI accelerators. U.S. senators are seeking a 30-month block on NVIDIA advanced chip exports to China. But I do want to point something out. When we get into this environment where there are sizable valuations and the things that could potentially impact negatively an industry or a business or a company if things go sideways, if there is massive levels of demand destruction, or you just start to see that capex expenditures start to dry up. Baidu's basically saying, hey, let's take this off the table. Let's let this spin off. Let's let this be an independent business. Let's get back to what we do. And again, this is all about China's ability to be self-sufficient in AI hardware. It's reshaping the global supply chain dynamics for the data center build-out. But the idea of, imagine a company like Google spinning off all of its AI sides, everything that it does. And does that make sense in a world where valuations are just monstrous and there still is that greater fool theory when it comes to valuations? Valuation could exceed $3 billion, and everything in China should be in focus right now. WB, Weibo, I am going back in, everybody. We are back above that 20-day EMA, and I like Weibo. Going to buy a call somewhere around that $10 level. Look for that continuation of the EMA pushing the 8-day over the 20, and I am looking for a continuation back somewhere to that 12 to 12.50 level. I'll dig into that trade in a little bit because that's going to be what I'm going to be focusing on with our NVIDIA crew today. On top of that, well, we got one more thing to be excited about, and that's that Dell is raising prices 10, 15 to 20%. Dell's going to hike its server and hardware pricing mid-December, and this matters because this could be the first major sign of cost inflation through enterprise IT. So cloud and hyperscale operators may be facing some margin pressure. This is going to be very critical to be talking about come earnings season in April, the first quarter of 2026. Why? Because this is all about forward guidance. And as we know, when it comes to AI, and we've talked about this in the past with Tesla, and we talked about it in the past with NVIDIA, what it comes down to at the end of the day is the dream narrative, which nobody cares about valuation, and we talk about basically a world where the total addressable market is infinite, and there's just going to grow, and it's going to grow forever. And that's kind of what NVIDIA's CEO was trying to claim last time during that earnings report was it's just AI everywhere. And then you look at their inventory, and their inventory has doubled because they can't get all this stuff out of the warehouses. The reality is this. The financials eventually come home. The financials eventually come back and hit companies. And that is where the bears really start to roar. And we can really start to see a divergence in a large number of these tech companies. Some companies that are prepared for these shifts and these margin pressures and any upgrade cycles next year, and the ones who are just riding a narrative. So there's going to be a lot of divergence and a lot of setup to be trading a lot of these names as margin pressures start to impact companies. It's 9:03, and Charlie has not said anything to me yet. Oh, he did. See, I'm still ranting. I'm just happy you're awake, Charlie. I thought maybe you were still asleep. Charlie likes to sleep in on Fridays. He is prompt. All right. KTOS is on our list. And great company. Great defense name. It has bounced around. It was a solid momentum player. We had a recommendation on this very cheap, and it just ran, and we took profits, and we thought that we were brilliant, and then it tripled. Hey, remember, the purpose of the market is to sell, and the purpose of a market is to take gains. Don't feel bad about that. But we're back above that key 50-day EMA, and I like that. I like the idea of just doing something really simple. Buying a stock. Oh, my goodness. What do you mean you buy a stock? I mean, I buy a stock. I legitimately buy the equity and I hold it, and then I hopefully sell it at 100. But what about options? I don't need options. I'm just trading momentum, man. That's it. We're above key moving averages. We're pushing back above that 50. I can buy the stock here. I could set a stop at 76 if I need to. Currently 77.77 is our 50-day. So I really like this company. I really like everything about this damn company. But if I have to do something with options, I will. I don't mind trading options. I just would prefer to be the guy who says, hey, I bought the stock for 77 and I sold it for 100. And everybody goes, well, I bought NVIDIA. I said, that's awesome, man. Good for you. But if you want to do something with options, you can, because it's still a little bit of a wide spread on some of these stocks, no doubt about that. But if you want to go out into like January, I'm not going to fault you for looking at something like the 67 or the 65. If you wrote the 67 for January and you bought the 65, and you're going to be heading into earnings, I believe. But you've got a 33% probability, a 76% probability of profit, 33% return. You're writing the 67.50 and you're buying the 65. That's down here. That's down here at that recent low from November 21st. And I'm okay with that because, again, I like this name. I'd love to own it cheaper, but kind of comes down to what type of momentum you want to focus on. I like to be able to focus on that higher probability of profit. If I went down to the 65 level, again, there's a wider spread here. That's the challenge. You have to be able to set that gap and fill it. But if you are able to fill in that range, you could even find a way at that 65, 62.50 to fill somewhere around a 20% return, 80% probability of profit. I just like the stock. I like the stock. He likes the stock. That should be put that on a t-shirt. SMR, well, I guess we're back to this stuff again. You know, these are the things that pop up in the world of financial newsletters. And I know that world. And these are the names that everybody goes, all right, well, hey, guess what, everybody? We're going to be in a brave new world where we're going to have all of these new nuclear power plants, and it's going to be incredible, and they're going to be all around the country. And, oh, yeah, you need permitting, and none of this stuff's going to be at scale until 2043. But don't worry about it. Invest in it now. What? This stuff is pure momentum. It's pure momentum because it's still based on a hype scale. I want to point something out about NewScale Power Corporation, and I want to also point out something very simple. And understanding the difference between a investment and a speculation. Kratos Defense is actually an investment. In fact, like LMT, all of the defense companies, because that money's not going anywhere. No matter what happens in the United States, we're going to be spending a lot of money on defense. It's not going to change. But here's the thing. You are still wagering on an SMR, on a company like this. You are still wagering on not just the next administration, but the administrations in 32, 36, and 40 to follow through on this stuff. And there's no guarantee on that. So what do? You trade this because it's a momentum name, and because, once again, once we get back into a positive momentum environment, and we start talking about nuclear power, we start talking about all of the fuel and everything that comes with the reactors, okay, it's a momentum stock. The company's unprofitable. It's trading at 100 times sales. 100 times sales. That's 100 years of revenue to justify its valuation. No taxes, no R&D, no nothing. 100 years of revenue. That's insane. It is still a dream, and that is okay, because what I want you to recognize is it's not an investment. It's a trade. And if it's trade, have rules around it. This thing can get back to 35 in a week and a half. No doubt about it. And if momentum is returning to the market and the optimism's coming back, and we're all talking again about super cycles and everything else, like the narratives change so damn often, follow the moving averages. If this thing is breaking under its 50-day moving average, it's likely tied to, I don't know, how about the negative Russell 2000 reading that we had on October 30th? And the momentum breakdown that we saw from 41 to 18. There's a lot of people who are going to look at this stock and say, I don't want to trade this anymore. Okay, I will, because as we see, when we get above some of these key EMAs, this thing just rolls. It is a liquidity-driven trade. We just came out of oversold. And if momentum remains positive and you just keep a tight level, look, I want to get above the 20-day EMA. I want to be above 23.52. We get above 23.52. I'm in. I set a $1 stop, and I see if this thing can ride back to 40. That's it. I don't care if they're ever going to build any of these things. The only thing I care about is the stock and whether or not it's going up or down, and whether or not I have clear rules in play of just simply buying this name. I don't care about the narrative, because I don't necessarily believe it's ever going to happen at scale. I think at some point we're going to end up with somebody who sits here and says, well, Fukushima, so therefore we're not going to do this. Unfortunate, but it's where we live. Energy fuels, rebounding, strength and momentum, same narrative, same story. A lot of people coming off the sideline. And here's the fun part about this. When you start to actually focus on these names and you see how they are related to broader market momentum, November 21st being that bottom, that's where the Japanese stimulus comes in. That's where the insider buying picked up. That's where momentum returned to the market, particularly the Russell 2000 yesterday. We're back above the 50-day EMA on UUUU. Cool. I have a natural place to get out in the event that the stock does pull back. That's $16. What's the upside? 26. Right back where we were. And there's no reason that it can't. Oh, and by the way, 17% short float. Momentum back back, back, back. Buy the stock. Don't get greedy. Don't be crazy. And in fact, keep in mind, there has been lots of insider buying on this stock this year, but it was back here at $7, $8, $9. So what do? You could sell spreads under that 21 level, November 21 level, 12.10, 11.9, heck, even go 13 down to 11. You could sell spreads, or you could buy the stock and just set a stop. That's the idea. I like buying certain equities when our Russell reading turns positive again, because all I'm trying to do is, honestly, just look for a short squeeze. I don't need to do much else. So I'm long all three of these names, and I'll be long all three of them when the market opens. KTOS, UUU, SMR, and I'm setting tight stops. 3% basically on every single one of them. To the downside, this is tough, right? It's very, very tough because, well, everybody's waking back up again. But I do have to look for some possible names that will continue to break down. Lennar is right there. This was part of concerns around downgrades. This was a 115 target for JP Morgan. Not good. That is a sizable downgrade for a name like Lennar, even in the face of the possibility of rate cuts. Same type of thing. Breaking down, how do you trade it? Buy at a key level, put in the money, sell out of the money. Not going to dig too deep into that at the moment. We'll talk about that later today. IP, which is international paper. I mean, I'm not going to spend my day trying to trade around the packaging container world. I just don't think there's much of an options chain to do something like this. But I will just simply note, hey, pay attention to the fact that on the consumer cyclical side, these are the businesses that are under pressure right now. And as we look at these moves that have transpired with international paper, lower highs, lower lows coming out of that period, if we get down here into that 30 range, possibly even lower, that's where I want to be very worried about its dividend. But I also want to start to pay attention to what the 13Ds, 13Fs are saying about a name like this. This is where large institutions step in and buy shares and possibly even engage in turnaround strategies if necessary. Insight, I don't know much about Insight. All I know is the stock has gone from 55 to 100 in a year. I couldn't tell you what they do, but you have these momentum moves. Healthcare is weakening a little bit. And if that is the case, again, you see lower highs, lower lows on a name like this. If that is the case, I kind of want to get out of the way, and I want to just basically take a little bit of a shot down here toward these lows down around 93. Other names to watch today, HIMS. I've been talking about it. Please don't tell me it's up. I should have bought this yesterday. Let's see. This is like a drum roll moment for me. Okay, good. All right. What I'm looking for on HIMS is a crossover here. 8 on the 20, and possible a little bit of a pullback to that 39 level. I just want to point out, when this stock breaks above these key moving averages, you have some pretty violent moves. There are multiple days to cover for this stock. So if this equity market does really kind of ramp up, particularly on the backside of the Fed meeting, this ridiculous stock could easily squeeze back to the 50s, back to the 60s. Watch the momentum, focus on the 1 hour, look for a rebound, and follow the necessary flows. In addition to that, SoFi and Nail are in place as well. NAIL is the home builders. They've been shopping around. You just had the Lennar news. I'm just not going to force anything in this environment. Watch Nail on the backside of the Fed meeting. Very important to keep an eye on that. And SoFi, which, again, I keep forgetting is a public company. Another offering, another sell-off offering, and this brings us to volume-weighted average price. All right, my wife remembers Ponderosa. Cool. All right. Hey, everything is in play today. It's the best time of the year, and that is volume-weighted average price. And if you don't know what volume-weighted average price is, well, this is just a nice little reminder for you. The VWAP stands for volume-weighted average price. I've said it 6 times if I haven't beaten into you yet. It is the average price for a stock is traded during the day weighted by volume. It tells you the true average price being of big money paid for that stock. Are these temporary closings or permanent? I don't know what you guys are talking about. I'm going to keep going. Because it weighs heavier trades more than light ones, institutions use VWAP as a benchmark. Mutual funds, hedge funds, algos try to buy below VWAP. What does that mean? Ooh, well, let's go up to our good friends here. TradingView, we also have this, a video on this for Thinkorswim. We'll throw that in the chat in a moment. But as you're looking at this right now, you see these multiple bands here. That blue line is volume-weighted average price. That's the average price divided by volume. Okay, so why does all of this matter? This is your first standard deviation band. I'm going to turn some of this stuff off real quick. This is your first standard deviation band. That represents roughly 68% of all expected price movement. This is 97% between the second standard deviation bands. Third standard deviation band, 99.7%. Now, what are we looking for? We are always looking for moves outside the third standard deviation, particularly for the S&P 500, the NASDAQ, the Russell, and all of the very high volume stocks, NVIDIA, Apple, Amazon, all the way through. Because we go back to what Stanley Druckenmiller said in Real Vision back in 2018, that there is no real trend. We have seen an environment, remember, we don't have markets that fall 4, 5, 6, 7% in a day. They just don't. That has really kind of gone away. It was not too long ago where a crazy person in North Korea would fire a broken missile into the Pacific Ocean and the S&P 500 would fall 4% in a day. That has not been happening. And one of the theories and arguments is, look, it's a heavily driven market by passive flows, leveraged funds, and, of course, algorithms. So what does that mean? It means that trend goes away because when you have these deep sell-offs into these statistical kind of improbabilities, I'm not going to call it extremist stand, but I'll call it the fourth standard deviation of price. What ultimately happens, unfortunately, for the Stanley Druckenmillers of the world is that the trend does not continue to the downside in that trading session. Instead, what happens is we squeeze back. They step in, they bid up. I miss those days too, Mark. Like, those were the days to go to Ceres in Chicago, which, by the way, serves breakfast. That said, what you're looking for, again, is these moves to the downside. Now, mutual funds, hedge funds, they will try to buy whatever they're trying to buy under this level, right? They're trying to buy under this level and sell above so that they don't move the market or show their hand. But I do want to point something out. If you are a person who is trading those big names, the NVIDIAs, the Apples, the Amazons, even the SPY. Well, here's the question for you. If you're buying puts, I'm going to tell you right now, if you're buying puts, particularly short duration, and you're buying them down here in the third standard deviation band, you got an issue. Because the problem is if it drops down here and we squeeze back up, your position's blown out. So where would you, if you have a thesis to short, where do you want to be shorting? Up here. Up here. And that is the key thing to keep in mind, that when it comes to markets and when it comes to channels, we don't go straight down. What we tend to see is this process of these channels, which are over a duration or a period of time. I'm going to go to the 30-minute chart real quick. You can see when we got into this kind of negative channel, lower highs and lower lows, right? It's not going straight down. It's squeezing up. And what happens is funds are using these pops to sell back into pressure. Well, now we've gone the other way. Now we're in a process of higher highs and higher lows. And that's kind of been the reversal, that point right here. This is where Japan stepped in. And this is where cutting shorts became the right play to do, right? It just took off. And now we're kind of plateauing a little bit over the last couple of days in this range between 680 and 685. We're looking for a catalyst. The only potential significant catalyst is likely next Tuesday or Wednesday. And we're either going to roll over and start this process of selling into Third Friday. That's kind of what my expectation it would be. Or people get excited about the Fed. because they're going to forecast potential more rate cuts in the future, and that's just going to take us to all-time highs and take us into the Santa Claus rally. But VWAP on a day like today is critical, and it's critical because, and I'm wrapping it up right now, Don, you are looking for these moves, right, to the downside. And then if these start to rebound, and I'm adding in Bollinger Bands and I'm adding in volume weighted average price and anchored VWAP, other tools that I can use, I have short duration options that expire today, 0 date on everything. So if the S&P 500 is down here at 682 and we're in the fourth deviation, I'm buying the 682 for today expiration and looking for that bounce back. We'll continue to talk about this more during our live session today at 3 o'clock. As always, if you are not a member of Theo, I don't know what you're doing. These are the types of days to be in the room to get all of this expertise and all this knowledge. So click the link, name your price, make it very easy for you. And on top of that, just continue to focus on just building the knowledge that you need to get you into 2026. 2026 is going to be a very fascinating year. I'm going to compare it very simply to what happened in 2022. There's going to be a lot of action. So the more education you have right now, and again, you can name your own price for this month, the better you're going to be heading into 2026. I hope you guys have a great day. I look forward to seeing a lot of you today at 3 o'clock. And if you have any questions, support@theotrade.com. Put Garrett in the subject line. Have a great day, everybody. Don's coming up. No Panama.